Good afternoon, everybody. Thank you guys for joining us. My name is Jason DeBono, Vice President of NewView Trust Company, and today I'm going to be walking us through inherited IRAs. For those that are joining us live, if you have any questions at all as we go through this today, you do have the ability to, in the Q&A part at the top, to simply type your questions in, and those will show up on my screen. So forgive me if it looks like I'm looking at my screen a bit, but I'll be keeping an eye on those so we can talk through any questions that you guys may have. If you do, as far as audio goes, we do have all the participants muted simply because the number of callers and attendees today just makes it a little bit too difficult to deal with the audio. So please, if you do have questions, type those into the Q&A and we'll gladly get those addressed. Today's topic is a very interesting one and one that I think is important for everyone to understand. Even well before they either need to know what these rules and requirements are. Specifically, we're going to talk today about inherited IRAs, and this is an important estate planning strategy for those of you that are on the call as clients. And we encourage our clients to really talk to their beneficiaries of their accounts, specifically about how these accounts work and what they do. We're not going to talk today about so much about assets or other than maybe with some questions, but we're going to talk today about what are the basic guidelines and how does basic inheritance of IRA accounts work, and we'll kind of walk through what those options are. So whether you are wanting to understand your beneficiary options of an account that you may be inheriting at some point, or whether you want to understand the beneficiary options so you can make better beneficiary designations, either way, the rules apply universally, and so we'll talk through that today. Please ask questions as we go. I know I've mentioned this, but there's a little bit of complexity to what we're talking about today, and I want to make sure that everyone on the call is getting out of it what they expected to get when they joined us. So I'm going to start with a pretty busy slide, but I want to just kind of walk through this. So we're going to go through and talk about really all of the buckets at the bottom, if you will, but there's really a couple different types of situations or things to understand inside here. So if you take this first area here, which is the are you the spouse? So when someone passes away, the first question is, are you the spouse? If you're the beneficiary, the spouse of that the deceased. If you are, you have some slightly different options. If you are not the spouse, then you have different options than what the spouse may be able to do. The second area of consideration has to do with what type of account is it. Now, for illustration purposes and simplicity, anything that's pre-tax, so we're going to call traditional, but that also would include a simple IRA or a SEP IRA. So is it a pre-tax account or is it a Roth IRA? And there are some slightly differing rules for those. And then the next question is the owner over 70 and a half? Now, this only applies to traditionals. But it applies because they want to identify 70 and a half is when the IRS declares pre-tax accounts must be withdrawn on a required mandatory distribution basis. And what the IRS wants to confirm is at the date of passing, was the individual taking RMDs or was that individual prior to the date of taking RMDs? If they were, there's certain requirements that need to be met. If they were not, right, then there's certain options that become available. So we're going to walk through and talk about each of these, but those are your primary three things that you need to view and look at. Number one, is it a spouse? What type of account is it? And then number three, for traditional specifically, has that individual that's deceased, were they at or beyond the required minimum distribution stage, which is defined as 70 and a half? Now, I want to start by saying, and I probably should have mentioned this at the beginning, I am not a tax advisor or tax attorney, nor do I pretend to be. NewView Trust Company is a custodian of accounts. We are not tax professionals. We're not tax advisors. So when it comes to the individual tax and tax situations and estate planning tax, that is out of our scope and purview. And we certainly recommend anytime you're trying to pass assets down or you're in the process of receiving assets, that you consult with a tax advisor, because there are some landmines certainly. So we're not going to talk about estate planning, responsibilities today, nor are we going to talk about individual tax liability. We'll talk about some areas as far as whether tax may or may not apply, but we're not going to talk about what rate that would apply at and how that's treated, simply because, again, it gets out of our purview. But one of the options, and I'm going to go back to the last slide here before we wrap up, that we just talked about. But when you get into the different options that are available to you, one of the options that we're going to talk through is a lump sum. So in almost all scenarios, you have the ability, and I guess I can go back to that, and you can take a look here and see, and you can see lump sum is the one item that's across the board, no matter what type of account or whether you're a spouse or not. If you choose to take a lump sum distribution, first of all, you have to withdraw the account by 12/31 of the year following the year of death. So if somebody passes away in 2019, you would have until 2020, 12/31 to withdraw that amount. Now, whether you took it out, 15%, per month until it was gone, or whether you waited until 12/31 and took it all out, it doesn't matter. What it means is that it has to be withdrawn as a lump sum by 12/31 of the year following death. Lump sum does not incur a penalty, so there is no 10% distribution penalty, even as an heir. You may think because you're under 59.5, there's potential for the 10% penalty, but you'll find in most cases there is no 10% penalty for withdrawals from inherited or beneficiary accounts. And then as far as tax goes, if it's traditional, you do have to report it as income, right? And how much you owe and how you pay the taxes between you and the IRS. If it is a Roth, you have to report it as income, but it's generally not taxable as long as they've met the 5-year rule. What that means is that Roths have a 5-year seasoning rule where they're tax-free upon distribution. So if your grandfather was to pass away and you received the IRA, and your grandfather had set up the Roth IRA 10 years prior, and he passes away, and you inherited that account today, and you chose a lump sum, and it was a Roth IRA, you would need to withdraw all of that by 12/31 of the year following, and you would not be taxed on that because that account had been held in a Roth by the deceased for 5 years. If that was only held for 3 years, there may be some tax liability on some or all of the money because it hasn't met the 5-year seasoning yet. So it's important to pay attention in Roth accounts to not just assume that your distributions are tax-free. You want to make sure that it's seasoned. So for those of you that are looking at this from an estate planning tool and planning to pass assets down to your heirs, I don't know any other way to say it without sounding callous, but if you're planning to pass them a Roth so that they can have this tax-free income to your heirs, make sure that your Roth was established 5 years before you pass. So as you get later in life, you start getting closer to that point where the 5-year long question may be more of an issue. So just be mindful of that, and whether you inherit an IRA or planning to pass one down, if that 5-year rule is met in a Roth, it does pass tax-free from a standpoint of income tax to the recipient. But if you haven't met that, then you may be subject to some taxation on that. The lump sum, and this is not meant to be construed as advice, but just from a practical standpoint, generally the lump sum is the least beneficial option in the grand scheme of things for a variety of reasons. Number one, what do most people do when they get a lump sum? They get a big pile of money, right? And they go out and they spend it. And so you have a lot of issues that can transpire from that. My reason for saying the lump sum is the least beneficial is you eliminate or you trim away the number of years that this IRA money can continue to work for you in a tax-advantaged manner. So in lieu of a lump sum, if somebody's goal is to get the money out and get it out in a moderately quick time frame, then we usually, again, I say we don't make investment recommendations or endorsements, nor do we give tax advice, but it's generally more beneficial to take a 5-year. So I'm going to go ahead and skip through to the 5-year, and I'll come back to that slide here in just a second. But when we talk about the 5-year, the 5-year option is really the lump sum, but better. Because if you put yourself in a lump sum, you've got to take it all out by 12/31 of the following year. If you give yourself the 5-year window, and we'll go back to that slide in just a second, you give yourself 5 years to take it out. So if you inherit $100,000 in an IRA, and you take it as one lump sum, you're going to be taxed $100,000, assuming it's traditional. You're going to be adding that to your ordinary income for the year. Well, that can bump you up in a tax bracket. And if you don't plan to spend the $100,000, why take it out? Furthermore, the longer that it stays in the IRA, the more that it can grow. And the more that it can grow, the more they can defer taxes. What's nice about the 5-year rule is that the first step is you've got to move it to an inherited account by 12/31 of the year following the death of the account owner. Just like in the in the lump sum, you don't have to move it to an inherited account, but you do have to withdraw it by 12/31 of the following year. In this case, you can move it to an IRA that bears your name and the decedent's, and it is titled as an inherited account, but now you have 5 years to take that money out. And the beauty of that is you could take it all out in year 1, you could take it all out on the very last day of year 5, but you've given yourself the opportunity to spread that out. So using that same example of $100,000, you may not need that money, so you may want to take that $100,000 out over 5 payments. So each year for 5 years, you could take $20,000 out. You're gaining 5 years of growth. You're gaining 5 years of taxed advantage growth, especially if it's a Roth. You have no need for the money. You might as well let that money earn money for you in a tax-free manner, tax deferred if it's pre-tax. But this 5-year allows you to withdraw that money out of the account over a 5-year period. So you could choose to take it in any increments that you want. The only thing you have to adhere to is at the end of 5 years, you have to have every dollar withdrawn out of that account. What's nice is there is no mandatory distribution, so you're not required to take the money out piece by piece. You can take it out at your discretion. If it's traditional, it's added to your income as you take it out. If it's a Roth and it's met the 5 years, it's reported, but as a general rule, it is not taxable to you, which is obviously the best of the best. There is no 10% early withdrawal penalty under this provision either, so you can withdraw as you go without having to pay a 10% penalty. So if we go back to this slide, you'll see here the 5-year option is available when you inherit an IRA as a non-spouse, as long as the IRA owner is not over the age of 70 and a half. So it can be Roth at any age or traditional if under the age of 70 and a half. If you inherit the account in as a spouse and you decide to, and it's a Roth, you can make that your own account. You can take that as an inherited account over 5 years, or if it's a traditional and the decedent is not over the age of 70 and a half, you can take that as a 5-year distribution. So as you can see, the 5-year really is the lump sum, but better, because you're not prohibiting yourself from taking it in theory as a lump sum, but you're giving yourself the ability to take it over 5 years. Really, in today's environment, the idea of a lump sum distribution is somewhat not even used anymore. Most advisors automatically defer to the 5-year, and if the client so in fact chooses to take it all out at once, great. If they don't, they get that 5-year benefit. The third way, which I think is something that everybody should really be focusing their energy and efforts on when it comes to either inheriting or passing IRAs down, is the stretch IRA. So there's a lot of people that in the financial world, Ed Slott, big IRA guy, who speaks a lot about this. And the stretch IRA is really prolonging the tax benefits of the account. And if you think about why we set up IRAs to begin with, it's generally the tax incentive. And so if you can pass down that tax incentive to your heirs, that's a major benefit that you can offer to them. So that's something that you want to be mindful of from an education standpoint, whether it be an IRA you intend to inherit or one you intend to pass down. The best option from a financial perspective is almost always the stretch IRA. Please remember, if you do have questions, to simply get those typed in under the Q&A, and I'll gladly get those addressed. So in a stretch IRA, the first step is you have to set up an inherited account for each individual beneficiary by 12/31 of the year following the date of death. So if there is one beneficiary, you would set up one beneficiary IRA. If you have 3 beneficiaries, then each beneficiary would set up their own inherited IRA. So each one would read the decedent's name as well as their own individual name as an inherited IRA. And the amount of money that comes or assets that comes out of this decedent's IRA would be split pro rata based on the percentage that was defined by the account owner when they set up their beneficiary. So, for example, if there's two beneficiaries and it's 50-50, that's pretty straightforward. If it's 60-40, 70-30, that's obviously the wishes of the IRA owner, and the money would move into each individual beneficiary account in that manner based on what was declared when they established their account or modified over time. So it's important to make sure that you set up that inherited IRA. If you set up a stretch IRA, you are going to have to take money out every year. So this, you don't get the ability to pick and choose over a 5-year window. The IRS says you actually are declaring that you're going to take it over your life expectancy, and there is a uniform life expectancy table that you can pull up online, and it will tell you how much of the account you have to take out each year. Obviously, the younger that you are, the smaller the amount that needs to be taken out, both as a percentage and in dollars. So there's a lot of advisors and planners out there that suggest if you have assets to pass to your heirs and you have different buckets of money, that you always want to leave your IRAs to the youngest because it allows them to stretch it over their lifetime. So if you were to pass away at, say, 70 years old with a Roth IRA with, say, $1 million in it, and you left that to your 10 grandchildren, and they each took $100,000 of that into their Roth, they can grow it over their life expectancy. So depending on their age, if they're 10, 12, 14 years old, they're going to have a significant amount of time to continue to use that tax-free growth. So that's a real powerful tool of thought from a standpoint of who and why to leave IRAs to certain parties. So do remember that you will now have an annual RMD. Each individual that inherits the account will have their own RMD based on their own life expectancy. So if you leave an account to 3 people, each child or grandchild or whomever it is that you left it to will have their own RMD based on their life expectancy. If the IRA owner was over 70 and a half, all the RMDs are based on the original account owner. So if you pass away with a pre-tax IRA at age 71, your beneficiaries cannot take that money over their life expectancy because you're past what's referred to as the required beginning date, which is when you started your RMDs. The beneficiaries are going to have to follow your RMDs. They're not going to be able to choose to use their own life expectancy table. As we've already talked about, if it's a Roth or if they're under 70 and a half, the life expectancy table of each individual beneficiary is used. What's really nice about the way this works is the annual RMD is not the maximum they can take. So if my RMD only requires me to take out $500 from my inherited IRA this year, but I really want to take 10, I can. And so you can always take more, you just can't take less. You're required to take at a minimum the amount based on life expectancy. In the event that there is a trust used as the beneficiary, which is permissible, however, there are some things that you need to follow and guidelines, and who the legal counsel setting up the trust does need to be made aware that an IRA is going to be named, is going to designate that trust as beneficiary. So you want to make sure that you're utilizing all the right items. But in a trust, if the trust is going to remain as the trust, meaning the trust is going to hold the assets of that IRA beneficiary account, and that trust has multiple beneficiaries, the oldest beneficiary is what will define the life expectancy. So if my father were to pass away and there's 4 children, and assuming that he used a trust as the beneficiary and that trust was valid to receive that IRA or to become the beneficiary of that IRA, once that money is passed, we would, as the 4 of us in the trust, we would have to take RMDs at the trust level based on the life expectancy of the oldest sibling. Or we could choose to break that IRA up into 4 inherited IRAs based on the split of the trust, and then we would no longer be subject to using the life expectancy of the oldest child. We would each use our own life expectancy, but that would require us to move it to our own inherited IRA to do that. If we wanted to leave it in the trust, then it does have to utilize the oldest beneficiary's life expectancy table. There is no 10% early withdrawal fee, which is certainly a nice benefit. As we've talked about in the past, if it is a traditional IRA, then generally the distributions out of these beneficiary accounts are taxable in the year in which they were distributed. If it's a Roth and it's met the 5-year rule, then generally they're not taxable in the year in which they were distributed. So if we go back to our slide here, you can see that the Stretch IRA is universal. So everybody has the ability to take the Stretch IRA, whether you're a spouse or not, whether it's traditional or Roth. The only thing that you have to be mindful of in the Stretch IRA is that if the IRA owner was 70.5 prior to when they passed, and it's a traditional, you can only stretch it over their life expectancy. If it's a Roth or it's a traditional where the individual died prior to 70.5, then you can stretch it over your life expectancy. So it's very important to know the difference in a Stretch IRA based on what type of account and when the original IRA owner passed away. The spousal option that is only unique to spouses is what's referred to as a spousal beneficiary rollover. This is what we call making your own account. So in this scenario, if the beneficiary of the account is the spouse of the beneficiary, that spouse has all the options that we already talked about. So that spouse can treat it as an inherited account, or that spouse can roll the IRA directly into his or her IRAs or create a new one in his or her name. That has to be done by 12/31 of the year following the death, which is, as you can see, a pretty common theme. But let's talk about some of the benefits and some of the drawbacks. So the big benefit that most people view as a spouse beneficiary is there's no RMDs. So they can take it as their own, continue to invest that money, continue to grow it in a tax-advantaged manner, right? Make it their own and not be subject to RMDs like the Stretch IRA. The other benefit is when you make it your own, you can leave beneficiaries as well, and they can then take it over their life expectancy. So in the event that you inherit your deceased spouse's IRA, so let's say you have $100,000, your spouse dies as a $100,000 IRA, regardless of your age, you can move that money into your own account. You can then invest it just like it's your money and also designate your own beneficiaries so that when you eventually pass away, your beneficiaries can elect to take it over their life expectancy. So you get that extra stretching ability. If you receive it as an inherited account and take it out over your life expectancy and you pass away, you cannot, the heirs of that beneficiary cannot take it over their life expectancy. So you can only make a beneficiary IRA, a Stretch IRA once. Once it's been stretched or inherited as a beneficiary account, it can't be inherited again as a Stretch account. It has to be taken out in a lump sum. So when we talk about spousal beneficiaries, major benefits there to being able to make it your own account. However, depends on your needs for the funds as to whether or not you want to go that route. The drawback is if you move that money from your spouse's IRA into your own IRA upon their death, it's treated just like your IRA. If you want to take money out, you're going to pay a 10% penalty if you're under 59.5. So what you lose by making it your own IRA is you lose the ability to gain access to those funds prior to you turning 59.5. So for those that are over 59.5, it's a moot point. For those that are under 59.5, it's a very important consideration because if you're 40 years old and you receive an IRA from a spouse, if you make it your own, you cannot touch that money without penalty until 59.5. So what we see, depending on the age of the spouse, is spouses will look at the account and determine, you know, I will make this my own because I don't need this money to live off of. Maybe there was life insurance or other assets that I can utilize. So it may be best to put that money and keep it in a tax advantage manner, not draw any tax to the estate or create any tax liability for you personally, and stretch that account over your lifetime and then ultimately pass it to your heirs who can stretch it over their lifetime. Or you may say, hey, this is an account that I need the funds from, right? Maybe I have costs associated with the death, or I've got living costs, I've lost an income, and I'm not able to support, our lifestyle without it. If that's the case, then you do not want to set up a spouse, make it your own. You're going to want to set it up as an inherited IRA, just like we talked about. And then you're going to want to decide if you want to take it as a lump sum, a 5-year, or a stretch based on your life expectancy or the life expectancy of the individual that passed, if it's pre-tax and they were over the age of 70 and a half. I'm going to pause there because I don't have much more information to go through, and I want to pause there and I want to open it up to questions, at least give the opportunity to open up questions. I'm going to go back to the original slide here because we're going to kind of wrap up and talk a little bit about this, but if you do have questions, please ask them now. Again, I know we're talking about quite a bit of information here, but it's important that we cover it all to make sure that you understand what those options are available to you. So while you may or may not be typing in questions, I'm going to go ahead and just walk through this one more time because this is really, and you can Google, beneficiary, IRA beneficiary chart, and you'll see lots of things that'll pop up that'll look similar. They should all say the same thing. And what you want to do is simply follow the process. So if you receive an IRA, you simply want to decide if you're the spouse or not the spouse, and then you want to follow this down. As we talk through this, we talked about the fact that the lump sum really doesn't make much sense in any scenario. Even if you want quick access to the money, you're probably better off choosing the 5-year. I don't recommend taking out money out of the account until you intend to spend it. So because if you can leave it in there for 2 or 3 years, you're able to spread your tax liability over a longer period of time, and you're able to split, if applicable, the tax bill a little bit to this year, a little bit to the next year. If you take it all at once and don't intend to use it all, you're putting yourself potentially in a big tax, having a big tax payment for money that you're not using. So that's the lump sum. 5-year really represents the best option for those that want to withdraw money out of an account where the IRA owner was under 70 and a half, or it was a Roth, and they want to access that money as quick as possible. The 5-year makes the most sense. It's better than the lump sum, but it also gives them the ability to pick and choose how they take it out in whatever payment methodology they want to choose over that 5-year period. From a straight financial perspective, the stretch IRA obviously represents the best solution. For those of you that have IRAs that are going to be passing down to your heirs, we always recommend that you talk to your heirs about the stretch. It ensures that they don't blow the money as quickly as they can, but it also teaches them the financial prudence of this money working for them. And if they understand the tax benefits that are accruing not just to the IRA owner, but to them as the beneficiary over their lifetime, hopefully that's enough to cause them to keep that money inside the account and keep that traditional or Roth tax-advantaged or tax-free growth continuing to grow. So the stretch IRA, again, always represents the best option where applicable. And then lastly, if it's a spouse, the spouse has the make your own option, which is to simply take it as your own IRA. And we talked there to recap that is a great approach to truly stretching the account because you can keep it in an IRA as long as you're eligible, and then you can also pass that to your heirs who can then choose to stretch it as an inherited account, which is really powerful. If you're a spouse and you need access to the money, making your own is not a viable option because you're going to now make yourself subject to the 10% early withdrawal penalty because it's treated like your own IRA. So only go the make it your own IRA if you plan to maximize longevity, if you think there's a need for that money in that 5-year window or even longer. You should move it to an inherited IRA, not a beneficiary IRA, and take that money over your life expectancy as you see as the RMDs require, but also you can take more out as needs arise. So that is all the information that I have to cover today. It looks like we are exactly at 12:30, which is right on cue. Unfortunately, I don't see any questions that have come in. If you have them, certainly ask them. We're happy to get those addressed. But seeing as though there's no questions that educate you on your options, not only of what self-direction is, but all of the peripheral things that touch your account. We do encourage clients that self-direct to really talk to your beneficiaries about the types of assets that you hold, because they're going to potentially inherit those with the account. And we do get calls frequently where somebody has inherited an IRA and they want to take the cash out, and the account owns two pieces of real estate, or it owns an investment into a private company, something that's not easily liquidated. And it comes as a surprise to the beneficiaries, and they don't quite know what to do with it and have not been educated. So education is important. Understanding your beneficiary options is important. And it's even more so important when you have alternative assets inside the account, so that your heirs understand what they can do. And what you don't want them to do is make bad decisions that could jeopardize the value that you work so hard to build of the account by maybe liquidating prematurely, or not understanding the assets and not following through the full investment cycle from its intention. So thank you guys very much for joining us today, and whether you're joining us live or on listening to a future recording. If we can help in any way or you have any questions, you've got all our contact information there on the screen. Thank you.